All right, moving right along here. Next indicator up is going to be the Stochastic Relative Strength Index, or the sRSI. Now, this is an indicator used in TA that ranges between 0 and 1. We have talked about an oscillator and what they are. This is indeed another oscillator. So this goes between 0 and 1, or 0 and 100 on some charting platforms, and is created by applying the stochastic oscillator formula to a set of RSI values rather than to standard price data. Now, using RSI values within the stochastic formula gives traders an idea of whether the current RSI value is overbought or oversold. The stochastic RSI was developed by Tushar S. Shande and Stanley Kroll, and in their detailed book, The New Technical Trader, published in 1994. So it is a relatively new indicator. However, it's probably older than some of you watching this video. Now, while technical indicators already exist to show overbought and oversold levels, the two developed the sRSI to improve the sensitivity and generate a greater number of signals than traditional indicators could do. Now, the sRSI was developed to take advantage of both momentum indicators in order to create a more sensitive indicator that is attuned to a specific security's historical performance rather than a generalized analysis of price change. All right, so let's go into the chart. And first thing you're going to want to do is pull up your stochastic RSI. So you'll go again to the little F of X button and type in stochastic. And the first thing that should pop up, or the third one down, would be the stochastic RSI. Go ahead and highlight that, put that in your favorites, and add that to your chart. Now, one thing I have done is at the bottom of this chapter, there is a Tradingview charting tool that you can go in and use, and you can go through and practice what these indicators look like, how to use them, how to relate them to price charting data, and everything like that. So it's a pretty interesting feature on this course, something I really haven't seen on other courses, but I hope you guys enjoy it. So this is what the Stochastic Relative Strength Index does look like. Again, it's a series of two lines here. And you do have your overbought up here, which is above 80, and your oversold, which is below 20, excuse me. So if you click on the little gear to check out your settings here, you have your K line and your D line. So if you go back and reference previous lessons, we did talk about what those exactly are. You can turn your background on or off, but keeping your K and D line where they are at is highly recommended. And your inputs, so your K and D lines are going to be 3, and your RSI look-back lengths are going to be 14. Now, I don't recommend changing these settings as it's already very sensitive. Even in a strongly trending market, the stochastic RSI was actually developed to be more sensitive in strongly trending markets to give you more reliable signals, but it does produce false signals. So this is what the stochastic RSI looks like, okay? So let's move on here. So how do you interpret the RSI? It's really, really very simple. You can go through and you can find divergences, but the easiest thing to do is something similar to the MACD, which is another indicator that we'll get into in the next lesson. But basically with the stochastic, you're looking for bullish and bearish crosses. As you can see here, a bullish cross usually happens when the asset or security or stock is oversold and it's looking to move back into the uptrend that it is currently in, or you're getting some sort of bounce on a downtrending market. A bearish cross is the exact opposite. When an asset, price, security, whatever is overbought, it's about to head back down to the downside in either a trend reversal or a pullback. You will get these bearish crosses here. So this is exactly what they look like. Here is a bearish cross. And then you have another bearish cross here, you have another bearish cross here, and you have another bearish cross here. Now, typically, bullish crosses will happen down here in the oversold territory. However, you can get them to happen up here in the overbought territory. This usually happens typically in strongly trending markets to the upside. So as with Bitcoin, we are seeing a strongly trending market to the upside, and we will see these bullish crosses in the overbought territory. So let's go ahead and zoom back out to the daily here, and you will get these fake outs as well. So one thing I really haven't mentioned yet is you should not front run any of these signals. That's how traders get caught with their pants down. That's how you end up losing more money than you make. So again, trading should be done very minimally. You should not be entering into a bunch of trades. You should not be in a trade every day. You should be looking for trades with a high risk reward ratio, something we will go over in future lessons. But again, if you're only at this point in this course, I highly recommend staying away from trades, or if you're going to trade, go to the ByBit or the Binance testnet and trade for free without any actual crypto, so that way you're not risking losing any of your capital. So this is what the stochastic looks like on the daily time frame. We get these, consecutive bullish and bearish crosses here. This lets us know that price is probably consolidating down here in oversold territory before it's getting ready to head to the upside. And let's go ahead and look and see how this relates to price action. So as you can see here, this is the Bitcoin daily chart. It's been strongly trending to the upside for quite some time. We got the bullish cross here that just so happened to line up perfectly with the previous consolidation range right here. And as soon as the bullish cross happened, we did get a continuation to the upside. The same thing here when we got the sideways movement and almost a bearish cross here. We did get a bit of consolidation in this range. And then we saw the stochastic kind of recover a bit before continuing to head to the upside. And then you'll get these line out periods where really, the stochastic really can't get any more oversold when it's pushing 100. It'll look like these lines are just on top of each other, and that's exactly what's happening. And then sure enough, as soon as we got the bearish cross here, we got a little bit of what's called bearish divergence, right? So we have a lower high in the oscillator and a higher high in the price. This would be bearish divergence. This would be letting us know that the price is about to head to the downside in either a pullback or a reversal. And as you can see, we've had this consolidation range where the stochastic RSI has really just kind of been in the oversold territory for quite some time now before really getting ready to move back to the upside. Here we have a bullish cross where we saw the Elon pump just a few days ago. So here we know we got the bullish cross letting us know that price is likely continuing to head to the upside. And then, we got the fake out bearish cross here, and we may be looking at a bearish cross here in the near term. However, we are waiting for that bearish cross to officially happen before we are making any decisions on any trading entries or exits. Okay, so again, the same thing. We're looking for bullish and bearish divergences here. They're a bit harder to spot with the stochastic RSI, but when you do spot divergences in the stochastic RSI, they are typically much more reliable than divergences in the regular RSI and divergences in the MACD. All right, if you have any questions, shoot me a DM in Telegram. Otherwise, I hope you understand what this is. You're basically looking for bullish and bearish crosses and or bullish and bearish divergences. Do not adjust your default settings unless you really understand what it is you're changing. And again, look for bullish, bearish crosses and divergences. That's the stochastic RSI in a nutshell. Let's move on to the MACD.